Hey guys, welcome back to another video. Well, today, as always, we are going to be looking at what happened in the freight market last week and what we can expect for next week. Now, if you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. Let me tell you, my personal experience this week was not exactly what I expected, but it did prove to me once again that knowing the market, the freight market, is crucial to being able to make money in this business. I know I get a lot of comments saying that this is bull crap and that this doesn't matter, the market is dead, but you know what? I'll have to disagree with you guys. Knowing the market is extremely important, and I'll explain why towards the end of the video. Another thing I want to quickly mention is this Sunday I will be doing a live Q&A at 4:30 p.m. Eastern. So if you have any questions about the industry, you know where to find me. Ready? Let's go. First things first, let's take a look at what is happening in the general freight market. So I showed this chart every single week. For those of you who watch this every single week, I know it's probably repetitive, but for those of you who are new, blue is the volumes. How much freight is there in the market? The white line is the tender rejection. How much of the contract freight is being rejected and therefore sent to the spot market. A few reminders. The volume here is not from the load board. This is not taken from the load board. This is taken from electronic tender data. Number two, the higher the volume, the better, because it starts soaking up some of that capacity. Number three, the higher the tender rejection rate, the better, because that means that contract carriers are rejecting freight and therefore pushing more volume to the spot market. And the more volume on the spot market, the higher the spot market rates. So what can we see? Well, we can see here we have May right here. We can see that from the middle of April, volumes did go up. They have gone down since the beginning of May, but are on their way up again. Now, why has this happened? This can be potentially due to the looming produce season. It could be due to construction because of the better weather, but basically this reflects normal seasonality. During this time every year, volumes usually tick up. Now, in terms of tender rejections, we can see that tender rejections have actually been ticking up since the end of April, right here. They have been going down for the past day or so. We'll see what happens next, but they have been going up. Why is this happening? Partially, it's because of the volume. If you look closely, you can see there's a huge correlation. This part right here correlates with this. This jump correlates with this. This drop correlates with this drop. Does that make sense? So partially, it's because of volume. It could also be partially because capacity in the market is decreasing ever so slightly. Now, unfortunately, I do not have those numbers yet. I'm still waiting for them. But once I have the numbers of carrier population, I will be making another video. Currently, the rejection rates are at 3.05%. And one thing that is interesting is this is the first time we see over 3% since around the beginning of April, pretty much. Now, 3% is not a lot. 3% means that only 3% of that contract freight is actually getting pushed into the spot market. However, something that I do want to note is that even the slightest increase in those tender rejections can make a big difference to those spot market rates. We have seen this in the beginning of this year where the spot rates were pretty decent. The tender rejection rate was just around 5%. Now for the National Truckload Index for line haul only. As a reminder, this is based on dry van data and it shows us the average spot market rate with the fuel surcharge removed. It does not include fuel surcharge. And we can see that finally we had a small uptick. We have been at $1.57 per mile for a while there. Now it's 1 cent higher at $1.58. Nothing to be too excited about because the $1.58 is still lower than the cost of operating a truck for many carriers, but at least we see some upward movement here, which is always a welcome sign. Now, speaking of rates, spot rates, let's take a look at the spread between spot rates and contract rates. And currently the spread is 89 cents. What does this mean? This means that the contract market pays on average 89 cents more than the spot market. Now, last week it was 90 cents, I believe. So it's a decrease of a cent. Now, why do I keep showing this and why is this important? This gap between spot market rates and contract rates needs to close quite a bit from what we see. The reason is contract carriers can reject contract freight for many reasons. One of those reasons can be finding a better alternative on the spot market. Now, as long as contract carriers are getting 89 cents above the spot market, we know that the likelihood of them rejecting contract freight because of a better alternative on the spot market is slim to none. And because they don't reject as much freight, or there's not as much opportunity for them to reject freight, less freight ends up on the spot market. If this gap closes and contract rates and spot rates are a little bit closer in terms of the difference, then contract carriers will be more likely to reject for a better alternative, thereby sending more volume to the spot market, which will of course soak up capacity and increase those spot rates. Now, something that I didn't show before is this chart. In blue, we see the total count of new fleets authorized for hire. This is both interstate and intrastate. Basically, how many people entered the trucking industry. The white line is showing the amount of trucks from these new fleets. So we're looking at this a year back, right? From May 2022 until now, and how much it has changed. We can see that the total count of new fleets has actually decreased by 20.2%. It does not mean that new fleets are not entering this industry. They are, but 20.2% less than they were in May of 2022. In terms of the actual truck counts, they're down by almost 11% from the same time last year. So of course, this is a good sign. We can see there is a decrease. Again, it does not mean that fleets are not entering or carriers are not entering this industry. They are, just not at the rate that they were a year ago. So I know that I usually show diesel prices towards the end of videos like this, but in this case, I'm going to show it right now. And I have good news. Thankfully, diesel is still in free fall. And this is diesel truck stop actual price per gallon. So what we can see, we are in free fall, which is wonderful. And currently we are at an average of $4.17 per gallon. It's always good to see the diesel prices going down. If we look at this chart, it shows us whether diesel prices increased or decreased in market areas. Red means a decrease, green means an increase. And finally, the chart is mostly red with the exception of Colorado, Wyoming, Idaho, and Utah. Everywhere else, diesel prices are decreasing. Again, fuel is one of the highest expenses of any carrier, so the fact that at least this expense is decreasing is always a welcome sign because that money is not coming out of your bottom line. So now let's go on to specifics, and we're going to change it up a little bit. We're going to start with reefer volumes. Now, for those of you who are new to this channel, this map shows us the change in volume for reefers from last week, as well as general volume in every market area. If a market is blue, that means that volumes increased from last week. If it's red, they decreased, and the height of a market shows us general volume in that area. So for reefers, again, the first thing I look at is California, which is gray and red. Red means there was a decrease in volume from last week. Gray means there was no real change. Texas, gray, Florida, gray. And why do I look at these three? It's because of produce season, right? Once produce season starts coming alive a little bit, I expect to see this market become bluer. One thing I did notice is that the Nogales, Arizona market is bluer, which is probably because of the produce coming from Mexico into Arizona. So at least we have that going for us. Idaho is a little bit better, but in general, yeah, there are some small spots where volumes increased. In general, there was either no change or the volumes dropped for reefers. Nothing really interesting. Now we have the same exact map, but looking at reefer rejection rates. So what we can see right away is that the Pendleton, Oregon market has a decrease in tender rejections. And I have been saying that this was one of the better markets for reefers for the past few weeks. So unfortunately, it looks like that is coming to an end. We did see an increase in Texas, South Carolina, Georgia. We see parts of Mississippi as well, and some of these northern states, as well as New Jersey and Delaware. But in the Midwest, it looks like there was a decrease in tender rejection rates or no change at all. Now, something I also noticed is an increase in tender rejection rates in Florida. And I actually just read that there was an annual 75 Chrome Shop truck show, which could account for the decrease in capacity, therefore an increase in tender rejection rates. A lot of reefer carriers take the week off during this annual truck show that I never knew about. Finally, there's the head haul index for reefers. Again, as a reminder, a blue market area means that there are more outbound loads than there are inbound trucks, meaning that there is going to be tight capacity, more negotiating power for the carrier. Red is the opposite. And just as last week, we can see that California still has more loads than trucks. No one wants to go to California. We can see that in Texas, there is a market, Pennsylvania, New Jersey, Delaware, and some of the Midwest has slightly more loads than trucks in the market. But in general, I would say that there is still overcapacity even with reefers. Now, I dug up these two charts from Sonar, and this is based on data from TruckStop. This shows us the markets, or not the markets, the lanes that pay higher from last week for reefers and those that pay lower compared to last week for reefers. Now, with the lanes that pay higher, we can see a lot of California, Laredo, Ohio, Indiana, and Atlanta, Georgia. So those are the areas that seem to be coming a little bit more alive in terms of the spot market rate, but I'm going to attach these down below so you can see which lanes these actually are. If we look at the lanes that pay worse than last week, we have some Midwest, we have some Dallas. The worst paying lane is Portland to Los Angeles. It went down by 11% and is now paying a whooping $1.36 per mile. Yes, for a reefer. It is insane. Again, I'm going to attach these down below so you can see, but something that I want to let you know, Laredo, Texas is a market to watch. I will probably make a video on why later on, but this is a market to watch. Now let's do the same thing all over again, but just for dry vans, starting with van volumes. And we can see from this chart, yeah, there are some blue spots here, but for the most part, it's red, showing us that volumes for dry vans decreased from last week. Now, the places that they did increase, actually it surprised me, is the Northern California area, the Oregon area, and of course, Michigan. Everywhere else, I mean, it did increase in some random markets, but again, for the most part, it looks like volumes are still dropping for dry vans, which is a bummer. But let's take a look at tender rejection rates. Now, last week, I believe this map was pretty much blue, which was really, really nice. This week, it looks like there is more red here, which means that tender rejections on the big scale, they have decreased for dry vans. Although we can see that for the northern states, tender rejections increased. Jacksonville market. We have some eastern states here, Virginia, North Carolina. Yeah, North Carolina. It's not even South Carolina. Oklahoma. We have the El Paso, Texas area. And again, Northern California and Oregon. But definitely a decrease in tender rejections compared to last week. Dry vans are still struggling. This is part of the reasons we do not operate dry vans anymore. We're waiting for that market to turn. As for the dry van head haul index, as a reminder, red means that there are more trucks going into that market than there are loads going out, over capacity. Blue is the opposite. If I'm not mistaken, it looks a little bit better here. We can see that the West Coast is horrible. The West Coast and the western portion of the US, bad. Also, the Texas area, except for maybe the Fort Worth market, is pretty bad. We can see that actually right here, South Carolina, Georgia, parts of Tennessee, maybe North Carolina, and the Ohio area, as well as Pennsylvania and New Jersey, there are more loads coming out than trucks going in, which is nice. The problem with areas like this is that, yeah, if we look at the data, there are more loads coming out. But the problem is the overcapacity that's happening here and right here in Maryland and Delaware, it's going to go here. And there's not going to be any data for it, right? Because they're deadheading. So that's the bummer. But in general, it does look a little bit better. But if we look at the grand scheme, of course, there's still overcapacity when it comes to dry vans. So now in terms of the rates and the changes, we can see that Laredo is paying better, it looks like. We can see that Ohio looks like it's paying better, and Indiana is an interesting state. Now, there are a ton of different market areas here. Again, I'll attach it down below. If we look at the places that pay worse than last week, we can actually see a ton of Midwestern states here. Now, of course, there are some Eastern states, some plain states, but Midwest seems to be kind of on rocky ground. And it's funny because Midwest used to be my go-to market area for dry vans. So it's funny how quickly markets change. Now, taking all of that into consideration, we're looking at the head haul index again. I would say it's a good idea if you have a dry van to stay around the Indiana, Ohio, and the Georgia, South Carolina areas. Now, something to note, because I've been getting a ton of comments about it. When I say that a market like Ohio is a good market for dry van, the reality is there is no good market for any equipment type at this point. We're talking in relative terms. When I say good market, I mean that a place like Ohio is going to be relatively better in terms of your choice and the rate per mile than a market like, I don't know, Central California. Does that make sense? Finally, we have flatbeds, and unfortunately today I do not have that chart that shows the outbound volume versus inbound trucks. I simply did not have enough time to do it all, but if we look at this map, it's pretty much the same thing. The darker the market area, the more tight capacity there is, right? So there are more loads coming out than trucks delivering to that market. And nothing really changed. For flatbeds, we can see that the southern states are still the place to be. We can see that the Northeast is dead. We can see that in the West Coast, there are areas where you might have a little bit more luck. But something I realize, and I keep saying it, the luck that you will have in the West Coast will be West Coast to West Coast. It's pretty hard to get out of here once you get in here. Plain states are dead. So yeah, basically South is the place to be if you have a flatbed. Now let's take a look at the rates according to Truckstop. And what we can see is even though the southern states are the best states for flatbeds, there was no real change within the southern states. It's very interesting. We do see that some eastern states, like from the east to the east, is going to pay a little bit better. We can see that from California to California, it pays better. In terms of decreases, a lot of Midwestern states saw a decrease when it comes to the rate per mile for outbound freight, which is, honestly, it's not surprising. The Midwest is not the best place to be if you have a flatbed. At least the majority of the Midwest is not the place to be. But yeah, again, I will attach these down below so you can take a look for yourself. As I said in the beginning of the video, knowing the market is crucial to making money in this business. We saw that, for example, for the flatbed, the northeastern states pay relatively well if you're going from the northeast to the northeast, or from the northeast somewhere to the east coast. And let me tell you, this week on Monday, one of my flatbeds, the 48-foot flatbed, ended up in Massachusetts because I was an idiot last week and I booked a load to Massachusetts to kind of close out the month. And we had to deadhead over 500 miles to get the heck out of the Massachusetts, Maryland, Pennsylvania areas. We ended up getting stuck in Virginia, and this is the second day where I'm booking short loads around 200, 250 miles with deadhead for $1,000. Now, yeah, the rate per mile is fantastic. It's over $3, $4 per mile, which is awesome, but the gross is just not what I want it to be. And the worst part is that this is the second time that we're still stuck in Virginia. I just can't seem to get my guy out of there for a good rate per mile. So market knowledge is not just some ridiculous notion as some may think. If you know where to go and where to keep your equipment, you will be in a much better position than those that just book loads anywhere. Remember, a load might be paying very well to go to a certain bad area. But what happens once you get there, right? All of that newly gained profit will have to be wasted on either having to deadhead out of that bad area or on having to book a really crap load to a better area. Now, for those of you thinking, well, why did you book a load to Massachusetts for the flatbed then? You're absolutely right. I was looking to close out last month. I tried to book a load that paid a good rate per mile with a good gross just to close out the month. And I sincerely wish I hadn't done that, because this week is it's a challenge. Tomorrow is Friday and I have to book another load for this flatbed for the weekend, and I'm honestly dreading it because the loads that pay well from that area are going to Connecticut, Massachusetts, Rhode Island, New York City, Pennsylvania, basically markets that are really crap, and I really don't want to go there. Basically markets that are paying really crap, and I really need him to end up in a good area by Monday so we can start off our week right. So what do? I have a choice. Either book a really high paying load to a really bad area and start off next week badly, just like we did this week, or book a crap load to a good area, but next week we're going to have the upper hand. What do? Honestly, this is a dilemma that I'm constantly facing, and I think what I'll end up doing is booking a load to a kind of crappy market, but that has a decent deadhead to a good market so that I can get that rate per mile for this load and also start off next week, right? Maybe somewhere to Illinois or Minnesota, maybe Wisconsin. We'll see, maybe some remote part of Texas. I don't know yet, but the goal is to start off next week right and get a load that pays as close to $3 per mile with deadhead as possible. I'm crazy. Anyway, guys, I hope you found this video helpful. I hope that you found some information that will be useful for your operations next week. I am wishing you all a wonderful rest of the week, a restful weekend, and I'll see some of you at the live this Sunday at 4:30 p.m. Eastern. See you guys then.